From The Times and The Sunday Times, this is The Story. I'm Luke Jones. We are living globally in incredibly politically unstable times, you might have noticed. And fingers are pointing in all the usual places: Donald Trump, Middle Eastern instability, Russian wars, you name it. But is there another force to blame?
Japanese bonds
When the global bond rally really
bond slide.
French bond yields are rising.
The whims, worries and wants of the bond market, people trading in mainly government debt, have a huge effect on what governments around the world can actually do. It's part of the reason our own Chancellor, Rachel Reeves, is, we know, talking about raising taxes in the budget next month, rather than breaking her fiscal rules and just borrowing more.
used bond markets did not.
French bonds are falling with the 10.
Paul, it looks like Japanese bonds are joining the
signalling a lack of demand for the Japanese government bonds.
And there's now bond market jitters in France, in Japan, and in that safest of safe financial havens, the United States.
The used bond markets did not.
Government bond yields, which pay
International bond market.
30-year bonds
on the British bond market.
So who are these bond market traders? How did they get the power to leave so many governments so shaken and stirred? And is there any hope in stopping them? The story today: does the bond market run the world? In a newsroom packed full of intelligent people, Mehreen, Times economics editor, is, for my money, the most intelligent. Mehreen, you are economics editor at The Times, and we're going to be talking about bond markets. And if we had the money, we would have introduced you with the bond theme.
Can I hum it?
No, I don't think you can, actually. Such these straitened times. Can we start by you just plainly explaining what a bond market is?
Yeah, bondsplaining.
Yeah, bondsplaining.
It's actually become quite a fun pastime for me.
Because no one knows.
Well, most people who talk about bonds actually don't know what they're talking
exactly.
about, which is part of the problem.
I'd include myself in that.
Hence my self-identification as a bondsplainer. So a bond is effectively just a financial instrument which can be issued by governments and by companies to raise money. So it's an IOU. You, the UK government, or me, a company that makes pencils, I need to raise some capital and I want to raise, let's say, a nice £1 million figure. What I will do is go to the financial markets and I'll give them an IOU and say, I need you to lend me £1 million over a course of a certain number of years, let's say 5 or 10. And over the years of that financial instrument, I pay you a rate of interest. It's often called a coupon, sometimes referred to it as a yield. Now, I will issue that bond and people will buy it, but once they've bought it, they can also trade it amongst each other. And that's why you get fluctuations in the prices of bonds and the coupons of the bonds, so the return that people get.
Because it's not like that is only sold once and then just has to mature
it's
for 10 years.
It's not a bilateral contract that exists.
Yeah.
So if you bought my £1 million IOU and then somebody else says, Mehreen looks pretty creditworthy, I think I actually want that because I want to get a solid rate of return because I know she's going to be paying me 5% over the next 10 years, you will then buy that. So you can sell that. And when bonds are in demand, the price goes up and the coupon, so the rate of return, goes down. The more that they're bidding for that debt, the more that you get to service that debt more cheaply because you are top of the tree, credible value. You're the prettiest girl, in this sort of parade that we're talking about. Is international financial markets.
How much are we talking about is out there? How much are they issuing regularly?
So the UK economy is worth something around £2.5–3 trillion, and our debt to GDP ratio is basically 100%. So that is also the outstanding number of bonds that we have circulating around the world. So something around £2.5 to £2.8 trillion worth of debt is circulating. Now, we spend a lot of time talking about the bond markets right now, and I'm going to explain why. But I would say over the course of history, if we're going to do that kind of hit parade of like who's number one, number two, it's basically the UK. The UK is a country that has never defaulted on its external obligations. Even after periods of wartime, we have found a way to pay our creditors back. So we've never really imposed losses on people who hold these things called bonds. And in this country, they're called gilts. And sometimes that's mistakenly confused for guilt, as in the feeling of guilt, but actually comes from gilt-edged. So GILT, because that's the nature of which the bonds were printed on. It was a kind of gilt-edged
Oh, lovely.
certificate that you would get.
Nice. Who are the people who are trading and buying these even in the first place? I mean, who are they?
Great question. I mean, so we're just sitting across from the City of London. There are lots of banks, insurance funds and pension funds who hold debt. Now, pension funds have been a really important customer for UK government bonds because a bond is basically a certificate which you can say, let's say for 30 years, you're going to get a fixed return, a reliable return from a country like the UK. And that's really important for pension funds because they have these huge liabilities that extend out into our lifetimes because they're our pension funds. But one of the reasons the world has changed is some of those pension funds don't need to actually match their liabilities so much with assets. So they've been buying fewer gilts. And the kind of people that are coming into the bond market generally are what we call fast money, things like hedge funds. So they buy a lot of stuff with a lot of debt, and the whole point is they want to make quick returns on it, so they flip these things around. So that's why we've seen much more volatility in the bond market. We often talk about bondholders and bond investors, and it is quite difficult to describe who they are because it's sort of the entire sort of universe of people that are interested in returns and sort of steady returns. It's also worth noting that bonds are just supposed to be way more boring and less risky than stocks, right?
Yes.
So you often, when we get financial crises like the financial crisis in 2008, 2009, that's sort of equity related. Like there's some kind of mispricing of risk that's happened in the stock market, or the Great Depression, for example, a stock market crash. Whereas bonds are just supposed to be, especially for rich world countries, the most steady, reliable, boring, non-risky form of debt. They're not really supposed to be at the centre of people's sort of financial consciousness. But when they are, then you know things are really bad. And I guess the paramount example that people have in their head is probably Greece in 2010 or the Eurozone crisis in 2010, which is very much a fiscal crisis about countries who had borrowed a bit too much over their head, and investors decided they didn't want to hold their debt anymore. And that's when you get into sovereign debt crisis territory. And
yes, but in 2025, the people trading bonds and doing it for a quick buck, as you said, who are they? I mean, have you met them? I mean, are they just sort of like finance bros, the kind of normal sort of banking lads with the gilets and the suit jackets over the top? Those guys.
I'm afraid they are the gilet boys.
Yeah.
They do all sort of wear that kind of, is it the Patagonia fleece?
Or a gilet and then the suit jacket over the top. That's the
side parting, slicked hair, Loro Pianos on the feet, the man bag sometimes. And they're often referred to in quite sexy ways as like the bond vigilantes. So, when they decide that they don't like the look of you, they're going to sell your debt and they're going to stop buying it, and then they're going to force a political crisis on your country. Of course, we had that moment with Liz Truss in 2022. And I think one of the arguments that was actually made, validly, was that Kwasi Kwarteng and Liz Truss didn't do enough outreach to the fleece bros, to the Patagonia brothers, to actually explain to them what their fiscal policies were.
Yeah.
And actually, you do need to have some degree of like testing some of these ideas out on this universe of people.
Because they'll probably be paying for it.
And you basically need them to trust you because you need them to hold the debt effectively, and you need them to bank on you and give you a vote of confidence. So in some ways they are amorphous, but they're also very real, these people.
And how broadly, over the last few years, how powerful and important would you say these bond markets have been?
Everything I described about bonds being boring, stable, and where none of the action is, has basically been true since the financial crisis, where in rich world countries there was very little inflation and interest rates was zero, and sometimes in some countries even below zero. Now, what happened since 2021 is all of these things that we thought were true of the bond market, the stability and the boringness, basically get thrown out of the water. Why? Because suddenly it seemed we had inflation after the pandemic, we had an energy crisis, more inflation, and all these central banks who for years and years and years, whose job it was to actually try and raise demand and raise inflation and raise economic appetites, now had to suddenly fight inflation and raise interest rates from the zero, below zero, to, in this country, upwards of 5%. Right? Now, that was a massive shock for people holding bonds, and a lot of people got burnt in this environment because the bonds that they were buying, their value was only going up, and all of a sudden people couldn't sell these things fast enough because the entire paradigm of the world economy, low inflation and low interest rates, had changed. So loads of people lost loads of money, and I think it's important for us to recognise that because it also explains the reticence of some people to try and go back into the bond market. And I explained sort of financial crises. We haven't had a major one, but we have had pockets of one. And we had one in March 2023 when Silicon Valley Bank, which was a bank that tech investors, primarily in Silicon Valley, were using as their lender, had loads of US Treasury bonds sitting on its balance sheet. And they just always assumed that these assets were always going to rise in value. They got completely caught out by the fact that interest rates were rising and the value of these things was dropping like stone. And that bank effectively went bust. It then led to a kind of ripple effect of other regional lenders in the US also went bust. And in this part of the world, in Europe, it led to one of the most recognized financial institutions that people know about, Credit Suisse, also going bust. It had to be bought out by another Swiss lender. So we actually did have a moment where bonds suddenly became sexy and also dangerous financial instruments because the world changed so quickly.
Once you've been burned once, you're anxious about maybe being burned in this market again.
Yeah, it's total psychology, right? So now in 2025, we're in an environment where we sort of thought by now the inflation is getting rooted out, the interest rates went up, but they're slowly going to go down again. So maybe it's time tentatively, even if you did get burnt in the 2021, 2022, 2023 environment, to go back into the bond market. But the big question is, actually, is inflation really been vanquished? Are interest rates really going to fall? Or actually is what we've got used to now in the last couple of years actually becoming the new normal, which means you never want to hold a bond again ever in your life?
And if it's not going to be the new normal, are the governments upstream of that capable of turning the situation around? Which, I guess, is the big question mark over France at the moment.
Yes,
you have an issue in the economy, and it doesn't look like the political classes can actually sort themselves out.
Exactly.
And they're having an awful time with
Yes,
it.
so now
because of the bond market?
Well, I've explained the macro dynamics of what's happened to the bond market, right? In a broad sense, what's happened. We went from really low, no inflation and zero interest rates to loads of inflation and interest rates going through the sky, right? Now let's talk about countries within this. And specifically, you have to think about countries because I think when you're trying to invest in fixed income or bonds, you basically just always make a relative comparison about why it should be the US, or if it's not the US, it should be the UK. So you're always comparing. It is actually just a game about comparing the fundamentals of different countries to decide whose bonds you want. Now let's do France, right? So France has always been in the vulnerable category, a bit like the UK, primarily because its debt to GDP ratio is somewhere around 110 to 115%. It's always been a country where we just know economically the state has been big. It got bigger during the pandemic. And this kind of debt ratio with an aging society and pretty low growth are all of the kind of components you just don't want if you're a bond investor.
And they don't want cuts, so...
And so now, or at least since the summer of 2024, you have to add in a massive sense of political risk after President Macron surprised everyone in the summer of 2024 after the European elections by saying that he wanted to have a surprise snap election in France for his own parliament because he wanted to, one, sort of challenge the populists on the right and the left and potentially secure his own centrist mandate. Guess what? He didn't secure his own centrist mandate. And more than a year on, we are still failing to have majority governments in France. So this is why we have this constant drama now of French prime ministers being elected and then sort of cobbling together very small minority governments and then falling every time they want to present a budget. So what is the political risk? So I've just told you that France has always had this massive debt problem. It's also got a deficit issue. Its deficit is somewhere around 6%. And there is just a moment in which everyone thinks France just needs a government that's going to cut the deficit. And by cutting the deficit, it means they've got to cut a lot of spending. So some of the big things that have been in the French political debate is we've got to have fewer bank holidays, guys. You've got to work a bit longer. Some of the seminal pension reforms, which is incredibly unpopular, they just have to go through. We need to tax the rich a bit more. We need to spend far less on the state and collect more in tax revenues. Now, when you don't have a government with any majority or any sense of political will or mandate from the public to do that, that 6% budget deficit is probably going to stay at 6% and it's going to get bigger over the years to come rather than smaller. And this is the constant psychodrama that's happening in France right now. And I would just add, it's actually sort of the opposite of what's happening in the UK, because in the UK, we have a quote-unquote strong government with a large mandate. Labour were elected as a government on a pretty, maybe shallow, but very wide mandate to rule this country. And to be fair, I'm always talking about Rachel Reeves and her fiscal rules and her fiscal plans because she's very determined to stabilise the public finances. Doesn't mean it's easy. It's very hard. But the political will is there, and there is a clear sense of signalling and messaging to the fleece dudes that they want to stabilise the public finances. None of these things exist in France right now.
And are the fleece dudes making it worse in France, the bond vigilantes, because it's sort of a vicious cycle? They're seeing the lack of political will to sort this out, so they are fleeing holding any of those bonds, and that is making it more difficult for the French government to, continue operating, raising debt and the rest of it.
Well, yes and no. The fleece bros, they deserve quite a lot of credit because they are an important constituency when thinking about fiscal policy. But I hesitate to say this, they're also a bit dumb. They don't know how to price these things.
Name names.
There's one of them, Hugh. They're all called Hugh.
So Hugh isn't completely evil, but he's not.
It's not about
he's not the
evil.
sharpest spanner in the.
It's not about evil. It's about how do you price the risk of the second largest economy in Europe, by some measures the fifth or sixth largest economy in the world.
And they're French.
And they're French. So you got to be a bit plugged into French political debate. How do you price the risk of this country going into an economic death spiral led by extreme populists? So the politics is really important in this debate. And the reality is that there has been a sell-off in French debt, which reflects the political dynamics. But I'm surprised at the degree to which there hasn't been more panic about this, right? I would tell you that the economic fundamentals in France are very scary, but that's just actually not being reflected in the bond market. It's being reflected to some degree, but it's not like a Greek-style moment where they're going to need a bailout. There is weirdly enough, no immediate pressure on the government to do an emergency budget with massive austerity to quell down the bond markets, because the bond markets are we're not too happy about this, but we don't.
As you said, it's sort of like trimming a few bank holidays and the rest of it.
Yeah,
it's not...
so I think there's an underpricing of French risk. And my argument is the bond markets don't understand the political world that we're in right now. The direction of politics in rich Western countries is moving in a way that is in total tension and in contradiction to the things that bond markets have liked. What I see around in Trump and maybe with reform in the UK, but definitely in the Eurozone, is you have populist political parties who are loath to reduce the size of the state because they want to reward their voters with looser fiscal policy. They're far less het up on the idea of having independent central banks. They're more likely to want to politicize these institutions, which means they're more likely to tolerate high inflation. They want to boost growth because that's going to be good for their political credentials and their electorability. And all of these things are bad for what bond markets want. What do bond markets like? They're like low inflation. They're like very independent central banks. So even when inflation is high, those central banks will just do what needs to be done. They ignore politics. And they're like fiscal policy, that is tax and spending policy, which is relatively sensible, keeps your deficits low, and ultimately means your debt trajectory is sustainable, if not falling. Now, everything we know about where politics is going is that all of those things are not held in any way sacred by people who are in the political ascendancy in France, in Germany, in the US. They're in power. So there's a fundamental tension for me between the populace of the world and the fleece brother bond markets. And I don't think that both sides understand how much they're on a collision course right now.
Mehreen, we're talking about bonds, government bonds, and arguably what they have contributed to in terms of the political stresses that we've seen in various parts of the world. You mentioned there how bond markets particularly don't like some of the directions that we're seeing politics heading in the US and in parts of Europe where populism is on the rise. Of course, we have the rise of reform here. We've even got wild radicals like Andy Burnham suggesting that we just forget the bond markets. But we have a stable-ish government, even though there have been some political stresses. It doesn't look like they're going anywhere for the next 4 years. We've got a chancellor, Rachel Reeves, who seems absolutely padlocked to her fiscal rules. Keir Starmer, if people criticise him, call him a technocrat. Hugh and his Patagonia Gila must be thinking, this is great, lovely. UK bonds, please.
You've just basically totally described why I think the bond market hysteria in this country is a little bit misplaced. Because for now, the UK is relatively anomalous in that it did elect a centre-left, some would say centrist government. So it bucked the trend of so many other developing world countries where the right is, or the far right or the populist right is becoming much more in the ascendancy. It is very much wedded to the independence of its central bank, something you can't say about the United States anymore. It's very much wedded to independent fiscal watchdogs, the OBR, and a chancellor who's so committed to meeting her fiscal rules and making sure Hugh and his brothers aren't feeling too nervous, that when she had a little bit of a meltdown in the House of Commons, they got so worried that she wasn't going to be around that they started selling the debt. So that was basically the biggest vote of confidence you can ever really get from the so-called bond vigilantes, is that even the hint or speculation that her job might be under threat led to a sell-off in the bond market because people want her to stay. They want her to stay.
But that's a straitjacket for her, isn't it?
It's a very complicated relationship she has with Hugh and these guys, because in the one sense, they are the reason that she will stay in her job, I think, for the duration of this mandate. But they are also a rod around her back, because if she cannot please this constituency, then all hell kind of breaks loose. That's the kind of Liz Truss moment, right? Then she becomes a different version of Kwasi Kwarteng. I think for now, actually, she's going to be taking much more comfort in the fact that she's seen as basically the main bastion of fiscal responsibility inside the cabinet, someone who's sensible and credible. And those are reputations that I think can be lost very quickly, but she has, I think, to some degree earned it. And I think we're going to see it again on display when she announces her budget on November the 26th, where she's going to keep her fiscal rules. And by hell or high water, she's going to make sure that she meets them with a little buffer to spare.
Even though it would be politically easier to relax some of them, break some of them. So it is actually really hemming in her decisions politically.
Yeah, and you mentioned Andy Burnham, and I think his comments have sort of been a little bit taken out of context because I'm sort of with him in the sense that it's actually probably my job and my colleagues' job to explain why having a large debt and deficit and why having a gilt market that's so fragile means that the bond vigilantes or the bond market community is actually a really important constituency in your political debate. I'm like, well, they are there and they're very important, but we do need to explain to people during election times or when we write manifestos that a government is always going to be constrained by the level of its government bond yields, and that's an important thing that we're going to have to manage. And I think we're just a little bit, I wouldn't say we're dishonest about it, but there's a lot of opaqueness about who these people are and why they're important and whether we should be in hoc to them or not in hoc to them. So I think it's important to sort of have this quite honest debate about the fact that as a country as we are with a big deficit and a large debt, there is always just a degree to which we have to tread a certain line.
Yeah, but he was saying that we are in hoc to them, so we shouldn't be treading that line.
When I went back and I saw the comments and I read what Tom McTague, who's the guy for the New Statesman who did the interview, he also just seemed to suggest that he wasn't saying, let's just throw caution to the wind in the Liz Truss Kwasi Kwarteng way, but let's be more honest about the fact that we are able to do some stuff and not some stuff because of the nature of our bond markets.
We are seeing countries like Japan having difficulties with this as well. Previously a very sort of stable, well-ticking over economy. What's happening there?
Yeah, so often we would talk about how in this part of the world we're all becoming Japanese, as in we're all aging really fast, our debt burdens are becoming super high, and we don't know how to get out of this trap.
We're big into slippers.
Yeah, I think we are still becoming Japanese, but the Japanese are also becoming like us. Because I would say for the first time this year or in the last year, Japan is developing what looks like traditional Western-style populist economic parties. Japan has been in a very weird place compared to the rest of the world because while we've all been trying to deal with inflation for a while, they haven't had inflation for 40 years. Now, for the first time since the 80s, Japanese people are finally in 2025 experiencing inflation. And guess what?
They don't like it.
They don't like it. They don't like it when grocery prices go up. They don't like it when their yen doesn't give them as much purchasing power as they want to. Very similar story that we've had in this part of the world for a long time. Now, what's happened is that we have elements of kind of populism in Japan, and a bit like what's happened in Europe and the UK, it is then forcing the mainstream parties to listen and maybe force their own politics towards that direction. And a couple of weeks ago, the LDP, which is basically the party that's ruled Japan forever. It is a political monopoly in Japan. Since the post-war era, only the LDP have ruled the country basically unchallenged. But they've been losing their majorities and they've been forced into coalitions. They elected a new leader. To the surprise of most people who were thinking about the political dynamics of the LDP, I think her name is Sana Taikishi. She's been described as the Margaret Thatcher of Japan. And I would say that's basically what everyone says when a woman is elected the leader of a centre-right party. We all say Margaret Thatcher. Now, maybe the more opposite comparison actually might be the Liz Truss of Japan. So I've described the fact that the Japanese are experiencing inflation, which means that eventually they need to start raising their interest rates for the first time in a really long time. Now, the new leader of the LDP, she doesn't want to have high interest rates and she wants to do more spending because she wants to ameliorate the part of the Japanese population that feel really pissed off with what's happened over the last couple of years. She wants to spend, she wants to grow the economy, and she doesn't want interest rates to get higher. This is a catastrophic mix for Japanese government bonds, and that's why Japan is now also getting caught up in the bond maelstrom. And Japan's really important because it is, after the US, the second biggest bond market in the world. And their debt to GDP isn't 100 like us in the UK. It's 200% of GDP.
Wow.
Yeah, so if you really want to worry about which is a country whose debt market might blow up, lots of people are looking at Japan right now. And it's because, as I said, populist politics and stable bond markets just don't go together.
Japan has not really been in a debt crisis before, which brings us then on to the US, which I guess has been the safest haven in terms of buying US government debt, buying the dollar, what have you. Are there questions over them? Does the instability in the bond market even extend to the United States?
Yeah, so actually everything that I've explained should have had a caveat at the beginning saying all of this applies except for the US.
Oh, okay.
They can basically do whatever they want. Why can they do whatever they want? Why can they have the biggest debt burden, the highest deficit? Because they have the dollar, the currency that everyone in the world wants to hold, and the assets, US government bonds, that everyone needs because they're basically the oil that sort of lubricates the entire financial system. So in some ways, all the questions about what's the chance they're going to do with her fiscal rules, or can the French Prime Minister reduce the budget deficit, or how will the new leader of Japan's centre-right party do? None of these questions have any resonance in the United States because they just don't get this level of scrutiny, because we never ask these questions, because they are in the playground analogy. They're the prettiest girl, they're the biggest jock, they're the bully, they're untouchable, unimpeachable. You don't even bother them with these silly little questions about what's your bond market like? It doesn't matter. You have the greatest bond market of all time.
Still.
Well, and now suddenly for the first time, the prettiest girl,
Is
the
impeachable.
prom queen, she's got a bit of acne now. Her hair's not as what it used to be. People are looking at her thinking, not sure she's a 10 anymore. Is she a 10? Is she still a 10? This is such a sexist analogy. But this is kind of where we are. There is, for the first time ever, because of Donald Trump 2.0, and basically, effectively, a lot of things that we'd have described before, tariffs, undermining the independence of the central bank, record amounts of migrant deportation, all of the maelstrom of Trump policies have finally meant people are like, do I still want to hold the US government bonds? Do I still think this country should be deserving of its reserve currency status? And am I now going to get burnt by the Trump trade? That is happening. It's happening very slowly, right? So this is not a judgment that's going to go binary yes or no overnight.
And it's not a sort of Liz Truss Mageddon that they're on the cusp of.
It's not going to be Greece. It's not going to be Liz Truss. Is it a bit like the fall of the Roman Empire? Some people say it happened really quickly. Some people happen really slowly. I guess in hindsight, it happened both at the same time. But I imagine it's going to be a much slower burning loss of confidence. And the best way that when I think about what's the best proxy in the financial markets for the loss of confidence, it's probably actually in the value of the dollar. The dollar's been falling steadily for most of this year. In the first half of 2025, it's been the worst 6 months for the dollar since it became a free-floating currency in the early 1970s. And when people are selling the dollar, that just means that they want to be less exposed to the US financial system. And the reserve currency thing is also going to get chipped away at if we still see falls of the dollar. So, there's still pretty much a bond market whose dynamics are just controlled by different events. But for the first time in a long time, people are actually asking serious questions about the level of the fiscal deficit in the US. And I'll refer us back to a previous episode. One of the main reasons they're doing that is because the independent central bank, the Federal Reserve, may not be so independent anymore.
He's gunning for Jerome Powell.
Yeah, it's such a linchpin in how we think about things. So again, the same paradigm applies. Populists and bond markets don't go together. The world's most successful, outrageous populist right now is Donald Trump. He happens to be in charge of the world's biggest economy with the world's most important financial institutions. So he's going to test that theory to destruction. My only caveat would be that we're more likely to see a crisis somewhere else before it happens in the US, because I think the toleration of investors to keep being bullish about the US, because basically its economy is still fantastic. Its top 5 companies combined valuation, equity valuation, is bigger than all of the companies listed on the Euro stocks on the FTSE 100 in China and India combined.
Oh, wow.
Right. Trillions and trillions of dollars.
Yeah.
So we have a sense in which the US economy in some ways is outperforming beyond anyone's wildest imaginations, but the guy leading it, he's a little bit temperamental.
But all of this brings us back to that question of where does this go? Will we have some correction where the bond markets properly freak out, even if slowly in the case of the United States? Or a world in which they just have to get with the programme? And yeah, populists are on the rise in lots of different parts because people are voting them in and this is the new reality. Get on board, Hugh.
That is basically the question, right?
Yeah.
Do we enter a world where these so-called bond vigilantes just have to accept the kind of world we're in? And the world we're in is where states are bigger. The pressures on them for spending on defense, on climate change, on tech are bigger. That yes, they're getting older. Their debt sustainability is deteriorating, but you're all going to have to live with a world where your bonds are riskier assets, where they give you slightly more volatile returns and you're just going to have to suck it up. Or where they fight back and say, no, we're not having any of this. We want more austerity, we want technocratic governments, reduce your budget deficit, reduce your debt, and if you don't, we will literally concoct crises upon you, right? And in some countries, it's going to be the first, and in some countries, it's going to be the latter. And I think that's probably what's going to be. It's going to be a mixed picture where some countries get the benefit of the doubt a bit more because they have things like the European Central Bank that can always bail them out. In this country, the Bank of England will always kind of bail us out. And in other countries where there isn't that bailout mechanism, they are going to suffer a bit more. I'm going to put classically emerging markets in this kind of basket. Argentina is a very important example of basically a basket case when it comes to...
the US is bailing them out.
But they've got... Their best friend is Donald Trump, basically the bestest friend you could ever have. Like, if the jock and the prom queen are your friends, then you're basically fine in the social hierarchy of high school, right? No one can touch you. And that's where Javier Milei is right now. But there will be a world in which maybe Milei's not around, that people are going to reassess what Argentina is doing. They're currently reassessing what's happening in Japan. Similar things could happen in Germany. Similar things could happen in France. Nigel Farage could also happen in the UK. So I think we don't know what the response of the bond market is going to be. I think it's going to be a mixture of some degree of discretion and toleration and some degree of outright panic.
I've learned so much, Mehreen. You're sort of mixed between, you're sort of Hector from the History Boys and the Robin
I
Williams
love the
character
History
in,
Boys.
what's that film? Matt Damon. Robin Williams, Matt Damon.
Good Will Hunting.
Good Will Hunting.
Yo, that's the nicest thing anyone's ever said to me. I
No,
thought you
you're
were going to say like I
welcome.
was like Melvin Bragg.
No. But is there, I don't know, is there a way we can distill this into a sentence that maybe the slightly frazzled listener can scribble down on a beer mat, and it's something they can say to their friends which will sound really apposite and bang on the money, but incites no further questioning?
I think it's probably that the world's populists and the world's bond vigilantes are on a collision course and neither of them know who's going to win in the blinking contest.
Cheers to that. Mehreen Khan, economics editor at The Times. Her Monday column in particular is a very good read. You'll get that on the Times app with a subscription, or in the paper, of course, as well. Thanks for your company. That's it from us today. The producer was Shabnam Grewal, the executive producer was Kate Lamble, and theme composition and sound design was by Maula Seto. I'm Luke Jones. See you soon.